If you've opened a news app recently, you've probably seen the headlines. The S&P 500 is breaking another record. Tech giants are posting quarterly profits that look like the GDP of a small country. Corporate earnings are robust. By every traditional metric, the economy of 2026 is booming. But then you close the app and you go to the grocery store. You pick up a carton of eggs, a loaf of bread, maybe some coffee, and when you get to the register, the number on the screen makes your stomach drop. You pay it because you have to eat, but you walk out feeling poorer than you did 5 years ago. You drive home, maybe passing a help wanted sign that offers a wage that hasn't budged since 2023, while your rent or insurance has gone up 30%. You ask yourself, if the economy is doing so well, why am I and everyone I know struggling so much? This is the defining question of 2026. And the answer is that we are not living in one economy anymore. We are living in two completely separate economic realities that just happen to share the same currency. Economists call it a K-shaped economy. And if you don't understand which arm of the K you're standing on, it is very difficult to protect yourself. So what exactly is a K-shaped economy? Usually, when we talk about recessions and recoveries, we use letters like V or U. In a V-shaped recovery, everything crashes together, and then everything bounces back together. We're all in the same boat, but a K-shaped peg is different. Imagine the letter K, it starts with a vertical line that was the initial shock. Likely, the inflation surge of the early 2020s and the subsequent rate hikes. But then the path splits. The upper arm of the K goes up. These are the people and industries that have not only recovered, but are accelerating. They are seeing wealth accumulation at a pace we haven't seen in decades. The lower arm of the K points downward. These are the people and industries that never really recovered. For them, the crisis didn't end. It just became a permanent lifestyle. In 2026, this split isn't about whether you have a job or not. Unemployment might be low. It's about asset ownership versus wage dependency. The upper arm represents asset owners. If you own stocks, if you own real estate, or if you own a business that leverages AI, you are flying. The inflation that crushed everyone else actually inflated the value of your assets. Your home's value just went up. Your portfolio is thriving. The lower arm represents wage earners. If you trade your time for money and you don't own assets, you are on the downward slope. Why? Because while your wages might have gone up a little, the cost of existence went up a lot. And unlike stock prices, the cost of living rarely comes back down. Let's dig into why this is happening right now in 2026. It comes down to 3 specific traps that are widening this gap. Trap number 1 is what I call the sticky price trap. You hear the government say inflation is down to 2%. That sounds great. But inflation is just the speed at which prices rise. If a car is driving 100 miles an hour toward a cliff and slows down to 20 miles an hour, it's still moving forward. It didn't reverse. In 2026, we are living with the permanent scar tissue of the last 4 years. Prices for insurance, housing, and food stabilized at a new, painfully high plateau. For the wealthy, this is an annoyance. For the lower arm of the K, it's a mathematical impossibility. You cannot budget your way out of a 40% increase in rent when your salary only moved 10%. Trap number 2 is the interest rate moat. For a long time, debt was cheap. Now, interest rates have settled at a new normal. If you are on the top of the K, high interest rates are actually good for you. You have savings. You put your money in bonds or high yield accounts, and you get paid 4% or 5% just for having money. Your money makes money. If you are on the bottom of the K, you are likely a borrower, you have a credit card debt, or you're trying to buy a car. High rates mean you are paying significantly more for the exact same lifestyle. Money is flowing from the borrowers at the bottom to the savers at the top. It is a direct wealth transfer that happens every single month. Then there is the third, and perhaps most scary factor specific to 2026, the AI disconnect. For the last 2 years, we've watched artificial intelligence reshape the corporate world. But notice how it's doing it. On the upper arm of the KAI is a productivity booster. If you are a corporation, you are using AI to do more with fewer people. This is why stock prices or high profit margins are fat, because efficiency is through the roof. But on the lower arm of the K, AI is a wage suppressor. If you work in customer service, data entry, or even mid-level administration, your bargaining power is gone. You cannot demand a raise because there is a software program that costs $20 a month that can do 60% of your job. So we end up in this weird paradox. Companies are richer than ever, but they aren't hiring like they used to. And they certainly aren't handing out massive raises to the rank and file. They are hoarding the efficiency gains. The stock market rewards them for it, which boosts the portfolios of the wealthy, widening the K even further. This economic reality creates a massive psychological shift. It's why everyone feels so tired. The American dream, or the equivalent in any Western country, was based on the idea of mobility. The idea that you could jump from the bottom of the K to the top if you just worked hard enough. But in 2026, the bridge between the two arms is burning down. Housing is the clearest example. In the past, buying a home was the primary way a normal person moved to the upper arm. You bought a house, you fixed your costs, and you built equity. Today, with prices and rates where they are, the housing ladder has been pulled up. If you didn't buy a home before 2022, you are likely locked out. You are stuck renting from the people on the upper arm of the K, paying their mortgages for them. This creates a sense of hopelessness. It is why we see doom spending. People spending money on nice dinners or travel instead of saving for a house, because saving for a house feels mathematically impossible. It's a rational response to an irrational economy. So where does this leave us? The uncomfortable truth about the K-shaped economy is that it is stable for the people in charge. As long as the stock market is up and GDP is growing, policymakers can point to the data and say, look, the economy is strong. They aren't lying. The aggregate economy is strong, but the personal economy for 60% of the population is in a depression. If you are watching this, you need to identify where you are on the K, if you are on the bottom arm. The traditional advice of just save more is insulting. The strategy has to shift toward defense avoiding the high interest debt that feeds the upper arm and aggressively acquiring skills that cannot be easily automated by the current wave of tech. If you are lucky enough to be on the upper arm, understand that this stability is fragile. An economy where the majority of consumers can't afford the products being sold is not sustainable forever. Eventually, the bottom arm drags down the top. 2026 feels like two different worlds because it is two different worlds. And the first step to surviving it is to stop looking at the averages. Stop looking at the stock market highs and start looking at the structural gap that has opened up beneath our feet. The K-shape isn't just a chart. It's the architecture of our lives right now. And until we bridge that gap, the view from the top will always be obscured by the fire at the bottom. The economy has changed, and the old rules simply don't apply to this new split. We have to adapt. I'm going to be covering more on how to navigate this new normal in the coming weeks. So make sure you are subscribed and have notifications turned on so you don't miss those updates. Stay safe, stay educated, and I'll see you next time.